You can go for it.
Okay. All right. I'm going to go for it then. All right. Welcome, everyone. Thank you for coming to our first Women with Wisdom webinar for 2022. I'm Dorothy Lewis, founder of Financial Insights, and tomorrow, Financial Insights will be 41 years old. So happy about that. Today, well, before we say that, thank you to Hannah Elkins and Katie Stein for organizing this and putting this all together so that we could participate in the tax update. So our guest speaker today is Jeanne Sacks, and she is a CPA from Johnson, Stone and Pagano with 30 years of experience. And she does individual taxes, trust taxes, estate taxes, business tax returns. And I asked her if she was already in the swing of things, and she said yes. So she's also, I'm going to see if I'm going to get this right here, a CAP, which is Certified Chartered Advisor in Philanthropy. So we are extremely happy to welcome Jeanne. So take it away, Jeanne.
Well, thank you for having me here today, and happy anniversary. That's
Thank you.
A big accomplishment. So I'm excited to be here, and today we'll be covering some tax updates for individuals and a few items for businesses as well. Let's go ahead and get started here. Here is the 2021 tax rates for individuals. A couple things I usually like to point out on these tables, just because some people aren't always aware of this, is that you do get the benefit of each lower bracket. So if you're in the 24% bracket and you're married filing joint, that's where your income lies, is in between that 172,000 up to the 329,000, that you still get benefit of that 10% bracket up to 19,900 and the 12% and the 22%. The other thing I like to point out is this is the tax law in various areas has a marriage penalty, which means that for somebody who's single, they might have a better benefit than once you get married. And this is one of the instances where you can see that when you're in the higher income bracket, they're at 35%. When you're single, it starts at 209,426. And the double starts at 418,851. But you can see that where it ends, the 523,600 for singles, the double of that is not the 628,300 for married filing jointly. So married people at that point have a penalty for being married, in essence. This is the tax rates for 2021 for your long-term capital gains and qualified dividend rates. They do have a different rate than your ordinary income. There were some changes here to IRAs. The required minimum distribution is now at the age of 72. Your IRA and Roth IRA contributions for 21 and 22 are 6,000. And if you're 50, and older, I should say older, it should be $7,000 total. Beginning in 2021, the age limitation for contributions to IRAs was eliminated. That means that if you happen to be 80 years old and still working and having some earned income, you can still contribute to an IRA and take an IRA deduction. And lastly, the coronavirus related distributions that people took in 2020, there was an election you could take to spread the tax of that over 3 years. And this would be your second year that you would need to include that tax. All right. Retirement, these are the various different amounts for the other retirement numbers, like your SEP IRA, the simples, etc. And I think, Katie and Hannah, I think there were the slides. Were we going to be able to make those available to everybody?
Absolutely. Yes.
Okay.
Anyone that would like a copy of this when we're done, I'd be more than happy to email that to them. As well as this is being recorded, and it is going to be uploaded to our YouTube library tomorrow, which can be found through our website.
Perfect. Thank you. HSAs and FSAs, which are your health savings accounts and flexible spending accounts, those can now be used for over-the-counter medical products, including your PPEs. Also for 2021, the balance in your health FSA could be rolled over to 2022. The HSA caps for contributions for 2021 is 3,600 for self only and 7,200 for family. And 2022, that goes up to 3,650 and 7,300. Virtual currency, which is a really, really hot topic right now. The transactions on virtual currencies, when you sell one, it has to be reported as a sale, similar to a stock. It's reported on your Schedule D. The other thing that people don't always realize is that there's other transactions that are considered a sale. So I always tell people, think about it is, if there's a change in your currency and you did not purchase additional currency, that means you might have had a sale. So if you use the currency to go purchase a pizza or purchase another item, that is considered a sale of your currency and you have to report it. If you exchange a currency for another currency, that is considered a sale. So like my niece, she was buying currency through Coinbase, and Coinbase has a fee of like $3 per sale or purchase. And so the exchanging of it was cheaper, or there was no fee. So she was doing that thinking that she was being smart and not having to have the fee, which yes, correct, that is smart, but she did have a sale to report. She didn't realize that. So just keep in mind to watch for the different things that you're doing with the currency, that it might actually be a sale. Airdrops are treated like stock splits, and they're not taxed if you do not receive any new units of cryptocurrency. The hard forks are treated like dividends and are taxable if you receive units of new cryptocurrency. And the other thing that has been on the return for the last couple of years, but it's been updated, there's a question on the first page that asks if you've ever received, sold, exchanged, or otherwise disposed of any interest in virtual currency. And that you need to answer yes or no. And you are signing your return under perjury and penalties, all that kind of stuff. So you want to make sure that you do answer this one truthfully. If you are doing virtual currency and doing a lot of transactions, there are apps and programs out there that help you track the reporting for your tax return. So you can look into something like that. Coinbase, I know, offers like a transaction report as to what you need to report on your tax return. I know when I checked out like Binance, they didn't have a report at all that I could find. So just check your wallet where your currency is held and see if they already have some reporting that you can utilize as well to help you fill out your returns. Education. So 529 plans. You can now do $10,000 per student per year to use to be paid for tuition for elementary and the secondary schooling. And that is per year, where the second one here, the 10,000 can be used to pay off college debt. That's an annual limit, and it's not an annual limit, it's a lifetime limit. So you can just do that once in your lifetime. Student loan forgiveness. Most student loan debt forgiven in 21 through 2025 is tax-free. Standard deduction amounts. A lot of us are no longer itemizing and taking a standard deduction because of the amount of the standard deduction. So these are the amounts for 2021. If you are itemizing, charitable donation is one of the areas where we can do some planning in regards to that. For 2020 and 2021, you can take 100% of your adjusted gross income for cash contributions. That's up from 60%. So what that means is if you have 100,000 of adjusted gross income previously, you could take a deduction of 60,000 for a charitable donation of cash. And now you can do the whole $100,000. You cannot include money that's gone to DAF, or which is a donor advised fund, or a private supporting private foundation. Those two things are excluded in this. The other thing on this is you can elect as to which contributions that you're electing to take for the 100% versus treating for 60%. So it is an election on your return. So you want to make sure that you're working with somebody and doing some planning in regards to this, because you don't want to leave necessarily, maybe you want to take advantage of that 10% lowest bracket, or you might want to make sure that you're utilizing all of your deductions fully. And so you may not want to elect to take 100% and bring your AGI down to 0. There may be some benefits of not doing that. For those of us that don't itemize, they are allowing the $300 again this year for single people for cash donations as above the line deduction for cash donations, sorry. But the new thing this year is it's $600 for if you're joint. Last year it was just $300 no matter what, whether you're a single or joint filer. So it's now $600 for the joint filers. A couple ideas for in your charitable planning would be to do what we call a QCD, which is a qualified charitable distribution from an IRA directly to the charity. And we'll talk about this a little bit more in the next couple slides. And another one is to bunch up your donations. Say you normally typically give $5,000 per year to a charity, but you don't itemize. You don't have enough there to be able to itemize, so you take the standard donation deduction. You can bunch those together and say, I want to give $25,000 in 1 year and be able to itemize your deduction because now you've reached that limit. And then for the 2nd through 4th year, you're not doing a charitable donation and you're just taking the standard deduction. And some people go, well, I don't want to give $25,000 to my charity all in 1 year. I still want to give them $5,000 a year. And so at that point, then we kind of go, well, think about doing a donor advised fund, because a donor advised fund allows you to put $25,000 into that fund and take the charitable donation for it. But then you spend the money out of the donor advised fund and you give your charity $5,000 per year out of the donor advised fund later on. So it's kind of the best of both worlds in that regard. Also keep in mind that you can donate capital gain property. So if you have a stock there that has a gain and you're not wanting to sell it, but because you don't want to pay the tax on it, but you do want to give something to your charity, you can donate that stock, avoid paying the tax on the capital gain, and get a deduction for the fair market value of whatever it's worth. So you still get the full deduction to your charity. That there is a limitation on your adjusted gross income, and that one's 30%, assuming it's going to what I call a normal charity. If it's going to the non-operating private foundation, it's 20%. Okay, back to the QCD, the qualified charitable distribution. So if you're looking at doing this, you normally have a required minimum distribution out of your IRA. You've attained the age of 70 and a half, and say that required minimum distribution is 25,000, and you are not itemizing your deductions, you're taking the standard deduction. So if you were to take that $25,000 out of your IRA, you would pay tax on the full $25,000, and then you write a check to your charity. You don't get a benefit of it because you don't have enough there to itemize. So you've lost what we call, you've lost that tax savings on that charitable deduction. Well, you can do this, and this allows you to take the money and give it directly to the charity. It has to go from the IRA trustee to the charitable organization directly. And you can say, well, my 25,000 required minimum distribution, I want to transfer 5,000 over to the charity. And so then on your tax return, you get your 1099 at the end of the year. It says you received 25,000 out of your IRA. And on your return, you say to the IRS, you say, I received 25,000. But 5,000 of this is not taxable. And so I only have to report $20,000 of income on your return. And then you still get your standard deduction that you still previously had. So now all of a sudden you've excluded $5,000 out of your income that you normally wouldn't have. So this is a good tool to use if you're at this point where you have required minimum distributions. This cannot exceed $100,000 annually. There's one caveat to this, and if you recall a couple of slides earlier, I said that age requirement for contributing to your IRA has been eliminated. So if you're age 80, you can still work and put money into your IRA. And the IRS says you can't what they call double dip. So you can't take the funds, your earnings, contribute to an IRA, take a deduction for that IRA, and then turn around and take your required minimum distribution that you have for your IRA and give it to charity and exclude that from income. They consider that double dipping, that you're getting 2 deductions for the same thing. So to further explain this, because this one can be confusing, I figured we could walk through an example here. Jane, who's over 70 and a half, and she is employed. and she decides she's going to contribute 7,000 to her IRA so she can have that deduction and save the taxes on her tax return. So she does that. And then the following year, year one, whatever year it is there, she decides she wants to do that QCD and wants to donate $5,000 of required minimum distribution to a charity. The IRS says, that's fine, but it's all now taxable because you already took the $7,000 and you took a deduction for that after you were age 70 and a half. So that's fine. You now have to pay the whole tax on the 5,000. You can list the 5,000 as a charitable donation on your itemized deductions. But again, if you don't qualify for that, you've just lost it. So year two comes around and she goes, okay, I'm going to do the same thing again. I know I'm going to lose part of it. That's fine. I'm going to still do the same thing. So she does. So she had her original 7,000 here that she took a deduction for. 5,000 here when she did the donation to the charity was taxable to her. So it leaves the balance of the 2,000 here that is still taxable to her. So when she takes the $5,000 out of her IRA and gives it to charity, she's going to still report 2,000 of taxable income for that distribution. And then she gets to exclude the other 3,000. And the 2,000 that she had to include in income, she can again put on her Schedule A as an itemized deduction if she can. So what we're kind of telling people is this can get very confusing over years. If you do this for several years, it becomes something that you have to track and keep track and make sure that you're reporting it correctly. So just a couple of things. If you are over the age of 70 and a half and you're working and you're wanting to do some kind of retirement, if you have the ability to do a 401k, do a 401k. Or if you're self-employed, put it into a SEP IRA instead. The other thing is to maybe just not do the IRA deduction if you're wanting to do the QCD. So kind of look at some different options there if this is a route that you're thinking about doing. The other itemized deductions, you have medical expenses. That is deductible if it's in excess of 7.5% of your adjusted gross income. The 7.5% over time has fluctuated. It was 10% for a while, 7.5% has changed. Over the years, they have now made it permanent. It is now permanent 7.5%. PPE is considered a medical expense. Our taxes are still limited to the $10,000 here. So that includes your sales tax, real estate tax, the RTA tax on your vehicles. You can include that as well, but that is capped at $10,000. There's been some talk in Congress about increasing it, but it hasn't been done yet. And mortgage interest, I like to point this out on mortgage interest. It's been in place for a few years, but just make sure people are aware of that. If you have more than $750,000 in total mortgages for deductible interest, this would be first and second home or first and second mortgage on a home, that is capped. The interest is capped at the interest that's applied to the $750,000. Anything above that, the interest associated with it is not deductible. If your mortgage was in place at prior to December 15th of 2017, that cap is $1 million. Also, our home equity debt is no longer deductible unless it's been used for home improvement. So if you take out a line of credit on your home equity, and you use it for vacation or to pay off a student loan or pay off a car loan, that's not deductible anymore. And same with if you refinance your home and you take out $20,000 or $30,000, do the same thing. You have to then allocate your interest in between the part that was for the $20,000 that's no longer deductible and the rest of it that is. Okay, moving on to credits. There was a lot of changes in credits this past year. The child tax credit was increased. It was increased to $3,000 per dependent for under age 18. That's up from the $2,000 under age 17. If you have a child under 6, you get a total of $3,600. And you get $500 for anybody that's 18 and older. This is now fully refundable. This is one that they prepaid half of it from July through December. They sent monthly payments to people unless you opted out, which you could on the IRS website if you wanted to do that. It's based on your 2020 return that they sent out these payments. The adjusted gross income limitations here. So if you were single and you had children and your income was above the 75,000, you are not going to receive the full 3,000 or the full 3,600. It's going to start to phase out for you. There is one that won't reduce. So there's two phases, basically. It won't reduce below the $2,000 credit until you reach $400,000 if you're filing joint, or $200,000 for single or head of household for the AGI. This extra credit is only good for 2021. And it's reconciled on your return. So it's based, the final amount that you receive is based on your 2021 income. So if in 2020 you were below that 75,000 for a single person and you got the full amount here and they sent you half of it, well, when you do your 2021 return, you're actually above the 75,000 limitation there. Then it's going to reconcile that, and you could owe money back, or you could have more if it went the other way. So just to be aware of that. The other thing is the IRS, when they process your returns and you send in your return electronically, it goes through their computer system and everything kind of checks out within their computer system. Then they send you off your refund, or they process your payment. If there's any kind of flag that comes up, then a real person has to look at the return, which can delay the processing of your tax return. So we saw this last year. And IRS is severely behind in processing things, paper returns. They'll work on these returns for the 2021 returns first, kind of, but they have all this mail that they're still trying to go through. In fact, I have a return that's been there for over a year that still has not been processed. That was paper filed. So IRS is saying if you get this payment wrong, because you have to report on your return what you received, that half payment that you received from July through December, as part of that reconciliation. And if you get that amount wrong, then the computer is going to spit it out and a real person's going to have to look at it, and it's going to delay your processing of your return. So they have a way that you can go verify the amounts that the IRS shows for you as to what you received. And so that's setting up this IRS account, and it has a path here. I've put the path here as to where you go to go set up that IRS account to verify the amounts received. So I think it's very important to do that if you were receiving these this credit, these prepayments, so that your return is correct and can be processed. Child and dependent care is another credit that increased quite a bit this last year. This increased from 35% to 50%. And it also increased from $3,000 for one qualifying individual to $8,000. And if you had two or more kids, $6,000 to $16,000. So what that means, if you spent $8,000 in daycare for one child, you could have a $4,000 credit, the 50% of the $8,000. Or if you had two or more and you spent $16,000, you could have up to $8,000 of a credit. They raised the AGI limitations, the adjusted gross income limitations, quite a bit, from 125,000 to 400,000. So there's quite a few more people that qualify for this. It's also now refundable. The extra amount's only there for 2021. The expenses, there's a couple expenses that don't qualify for that, and that's your private kindergarten or higher grade level and overnight camp. And there was also some employer provided the care assistance amount increased as well. It doubled, a little more than double. Earned income tax credit. There were some changes to this as well. Earned income credit, tax credit is a credit for those that have relatively low income, kind of are in the poverty level, to provide some assistance. So this change was for 2021 only. There is a credit that's for people that have children, and there's credit for people that don't have children. So the one for the ones that don't have children, they lowered that age limit to 19. And they also made it no upper limit. So it used to be in between 25 and 64 that you could get this. And now they lowered it to 19. And it's age 24 for certain students as well. They also made the age requirement for former foster youth and homeless youth to qualify at age 18. They increased the amount from $538 for those people to $1,502, but your adjusted gross income needs below the $27,380 there. It's quite low. The other thing is that when you're doing a return, if you have this, if this qualifies for somebody you know, or you or anybody, need to be looking at the 2019 earned income as qualification versus 2021. If it's higher, it can calculate to higher credit. So just make sure that you're double checking that as well. And then we had the stimulus. We had our third round of stimulus that happened in 2021. There were actually two payments that people received. The first payment that was sent out really early in 2021 was for your 2020 tax return. It doesn't count for this return. The second one that was sent out is for 2021. This was $1,400 per person, so included the parents and the qualifying dependents. It had a phase out. So again, if you were single and you made $80,000, you could not get this stimulus amount. The one thing they did was, if they, again, based it on the prior year return, but it's really based on 2021, but since we haven't filed, they had to use a prior year. So if your income was, again, for like single, say, 60,000, and you qualified for the full amount in 2020, and in 2021, now you're above 80,000 and you didn't qualify for it, or any kind of in between that, IRS says, hey, if we sent you too much, you don't have to return the payment. We're not going to make you return those funds. If it's not enough when we're doing your 2021 return, we're going to give you the rest. And so you'll get credit on your 2021 return for that. Again, the caveat is that you need to have the right numbers on the return. So if you don't enter in anything that says that you're going to claim this credit, the IRS is going to say, okay, you don't want it, we're fine, we're not going to send it to you. We're not going to do it. But if you enter in a wrong number, the IRS will correct it. But again, that's going to send it out for that person to look at, and it's going to delay your refund. So go back into the IRS, set up that account, and verify what you received for the stimulus amount. Oops, I went too fast. Expired credits and deductions. These for individuals, these are the expired credits and deductions at the end, that ended at the end of 21. Mortgage insurance premiums, I think, is one that people utilize. The other one sometimes that I'd see would be this residential energy efficient one, where if you put in a tankless water heater, you could get, a couple $100 back on your return for doing that. And sometimes the solar credit. Those are the big ones. These ones a lot of times get renewed. So just be watching out in the tax laws for this year. Sometimes at the very end of the year, for this to be extended into 2022 or in future years. Estate and gift. The annual exclusion for gifts was 15,000 in 2021, and it's 16,000 for 2022. That's the first increase we've had in about 4 years. So that's a good increase. The federal exemption equivalent for estate went from 11,700,000 in 2021 to 12,060,000 for 2022. But Washington is still at 2,193,000 for estate taxes. Little tidbit on that, on Washington, that amount has not changed since 2018. And the reason it hasn't changed is that when they set this, the current law for estate taxes, it referenced a table for a cost of living increase on this amount for every year. And that cost of living table is no longer in existence that they referenced and are using. So that means that the state can't increase it until the legislator goes back in and fixes the law, which they have not done. So that's why it hasn't changed, and have no idea when it will change again. Washington capital gains tax, another hot topic. This is effective January 1st, 2022. It's been all over in the news. Last Friday was a court hearing where they, presented their arguments against this capital gains tax, arguing that it's an income tax and it's unconstitutional. I think the judge said he would probably have about 2 weeks or so before he'd make his decision on it. So we're kind of in that waiting period here. But we'll see. We might have an answer here in a couple of weeks whether this is going to stay in place or not. The first payments are due April 18th of 2023. It is the same time period. It's filed basically with your 1040. Washington State is going to want a copy of your personal tax return when you file their return. So I imagine all of our tax software is going to have some kind of forms in there that you can utilize. The rate is 7%. It applies when the profits exceed $250,000 annually, and it's to individuals. So pass-through entities, S corps, partnerships, trusts don't pay the tax, but they could have a tax, they could have a gain that is passed out to you. So the partnership itself could sell something that creates a long-term gain, which then flows out to you as an individual, and then you as an individual then would be reporting that and paying the tax. It applies to long-term capital assets such as stocks, bonds, business interest, et cetera. There are some exceptions. The big one is real estate. So that one does not count towards this one. And just a little side note, I love, and I listed the rest out here for you, but the one I really love is the goodwill received from the sale of a franchised auto dealership. So I always think that somebody had a good lobbyist, or there's a congressman in there that that has a dealership, or a whole bunch that pushed that one through. There is a charitable deduction amount here. It's quite high though. You have to do quite a bit to charity before you can start to get a deduction. All right, into some business type deductions here. Bonus depreciation. It is still at 100% for 2022. 2023 is where we start to see a change in that, unless they again change the tax law on this. Section 179 threshold amounts start at $2,620,000 for 2021, and the max amount is $1,050,000 that you can take as a deduction. Keep in mind that a lot of people are not utilizing Section 179. There is some planning reasons as to why you might do this, but because we have 100% bonus depreciation right now, and you can write off 100% of your assets, a lot of times people are utilizing that method first. For non-residential real property roofs, their heating and cooling systems, security and fire systems, all that qualify for Section 179 now. Like-kind exchanges are only for real estate. And then qualified improvement property, this came out last year, for non-residential, they finally corrected the law, and it is a 15-year recovery period, and it can qualify for bonus depreciation. So these are things that are generally your non-structural improvements to the building. Couple other items. The sick and family leave credit, which is related to COVID illnesses. If you were quarantined, had COVID, had to self-isolate, if you had a daycare that was closed, if you had to take care of somebody, anything that's kind of more COVID related, you could have a credit. If you're an employee, you would have had to report this to your employer, and they would have taken the credit for that on their return, and you would have not used your sick time. But if you're self-employed and you have one of these circumstances, you really need to be looking at this and seeing if you qualify and can take this credit, because it can be quite a bit. It's $5,110 for the sick leave and $2,000 for family leave. Teachers still get the deductions for their supplies, $250 for 2021, $300 for 2022. And it includes PPE equipment and supplies that they need for the classroom. Businesses can deduct up to 100% of the restaurant meals for 2021 and 2022. Yeah, so be looking into that when you're filing your return or classifying out those costs if you're turning it into your accountant. The PPP loans, if they're forgiven, are tax exempt, and the expenses used are just still deductible. Same with the EIDL grants. If you receive one of those, that does not have to be repaid. That said, the state, city, and county grants are generally taxable. I gave you the standard mileage rates here for 21 and 22. 22 is 58.5, 56 cents for 2021. And another hot topic is the 1099Ks. Sorry, moving kind of quickly because I know we're getting a little bit more on time here. But the 1099K is issued by like eBay, PayPal, Venmo, any of those third-party settlement organizations where they've issued you $600, or you've received, I should say, $600 for the sale of goods or services. So, I go on eBay and I sell my kids Legos, or, their Xbox or something like that, and I happen to sell $600 worth of stuff, I will get a 1099K for 2022. And then on your return, you're going to have to report that, and you'll have to report the expenses associated with it. So, I can take my costs of that purchase of that Xbox or those Legos against that, which will bring it down to zero, because usually I'm selling it for way less than what I paid for it. As a personal item, you can't take a loss, so you can only bring it down to zero. If you're in the business of selling these types of things, if that's your business, then you can have a loss on an item, but not as a personal item. Employer retention credit. This is when it's very complex. So I'm just giving you a very basic overview on this one. If you have a business, you need to be looking at that, at this, and talking to your accountant and making sure that you have addressed this and you know whether or not you qualify for this, because this can be a rather large credit that you can get back. It's effective through 9/30/2021. And what it was when the IRS came out originally with these, or the Congress came out with the PPP loans, they said you could have one or the other. You could take the PPP loan and ask for forgiveness, or you could do this credit. You couldn't do both. Well, they later came out and said, hey, you can do both. Now we're going to allow you to do both. But your wages, this is based on the wages that you pay employees. So those wages, you can't say I'm going to use the wages from this time period for the PPP loan, and I also want to use them for the employer retention credit. You can only use them for one or the other. And the other one is that paid family sick leave. If you use the wages for that, if you got a credit already as an employer back for that, you can't use it for either one of these as well. So the basic qualifications are in 2020 or in 2021, if we were closed or partially closed due to a government order, and we were all closed in 2020. The only difference there, the caveat is there for like me, our office was closed, but we could all work from home. So we really weren't technically closed. Even though our building was closed, we were all still working. A restaurant though that was closed or shut down and could only do takeout order, they were partially closed. Or the gyms, they were fully closed. So then it's just a matter of, well, what did we use those wages for the PPP loan forgiveness? And if not, then we need to be looking at this employer retention credit, employee retention credit. The other way you can qualify is if your gross receipts have decreased. So, and for 2020, you're comparing a quarter, so like January through March, April through June, so those calendar year quarters, you're comparing that same quarter to 2019 and for the same quarter. And if your revenues decreased by more than 50%, then you qualify for this. 2021, it's the same thing, except for you're still comparing it to 2019 because 2019 was pre-COVID. And if your receipts had declined by more than 20%, then you qualify. The 2020 credit is $5,000 per employee max. It's 50% of your wages for the entire year. So if you have 10,000 or not 10,000, 10 employees, that's $50,000 that you could get back if they all had $10,000 in wages and it qualified during that period. 2021 is a lot larger. It's 70% of their wages, up to 7,000 per employee per quarter, so not per year. So many factors into this. Make sure you're talking to your accountant and seeing if you can get, if you do qualify for this, or your payroll service like ADP or Paychecks, whoever you go through. Okay, I think I left some time here, hopefully for some questions. If people have something, please let me know. I appreciate your time today.
Yeah, hello, Jeanne. This is Ernest from Financial Insights. How are you today?
Good. How are you, Ernest?
I had a client who asked me a question about the third stimulus check, and you covered it there. And they were under the 150,000 for 2020. They were going to be under for 2021, but they did some Roth conversions, and it pushed them over 160,000 for 2021. And I'm unclear whether they need to. Are they going to have to pay that stimulus check back or not?
That is one that they don't have to pay back. So when they're doing their return, it will calculate it and say you don't have to pay anything back. You're just not owed anything more because you didn't, because you got the full, full amount based on the previous year.
Okay,
you get, yeah. The child tax credit is the one that you'd have to pay back if you
Okay.
got too much.
yeah, that didn't apply to this person. So, but thank you so much for that. It was worth it to hear this because I was just asked this question about a week or two ago. So it was great. Thank you so
You're
much.
welcome. You're welcome.
Thank you so much, Jeannie. This was really a lot of valuable information that underscores the fact why I need a CPA. There are a lot of rules and regulations, particularly with a childcare credit and all of the youth kind of stuff, which I don't know
Right.
that well.
Correct.
Any other questions? Feel free to speak up. You just unmute, top right corner of your picture. And
Are we
again, this
good?
will. Go ahead, I'm sorry.
No, I was saying, I don't see any. Do you?
No, I don't.
Okay.
But we are going to make this available on our, oh, we do have one, Miss Regina.
Hi, Jeannie. I would like to
Hi.
ask a question. If by any chance you watched the hearing on the capital gains tax, what I'm really curious about is that I haven't seen them grant an injunction yet, and it was requested. And so I'm wondering if this gets appealed, does that mean that we have to file a return this year for our clients?
Well, hopefully it'll get resolved by the end of the year.
You think?
That's what
Okay.
I'm hoping. But there's been people that are saying that it's probably going to go to the Supreme Court.
That's what I'm wondering. And if
Yeah.
that could drag out for a couple of years, I'm curious
Right.
what will happen in the meantime for our clients.
Right. And so then in the meantime, if it doesn't get like no injunction or anything there, and we don't get it resolved, people are going to have to pay the tax in and then have to go back and ask for a refund. Or you don't pay the tax in and you know, if it does stay in place, you're going to owe penalties and interest for not paying it in when it was due. So they're going to have to make that decision. Yeah. Yeah.
Good question.
It's going to be interesting to watch it. It'll be interesting. Yeah.
So will Washington's residents have to file some type of paperwork with this new capital
Right.
gains tax?
Right. So it would be I want to say it'd be like a return. You'd be filing a schedule saying, here's my capital gains that I had, and paying the tax in and attaching your 1040 from the IRS to show what you reported for capital gains to IRS as well. So they're going to want to see that. It's a requirement there.
So
But yes, and I think your tax programs, like say TurboTax, are going to probably have something built into it to be able to file it at the same time, is what my guess would be. My cautious word is always that, you know, hey, once you've set this up, you know, you got one foot in that door.
Yeah, no kidding. Mhm.
Going towards that income tax. Now, you know, we'd have to change, you know, we'd all have to approve that at some point, I would hope.
Anything else? All right. Thank you so much, Jeannie. We really appreciate you
Thank
taking
you,
your
Jeannie.
time and great presentation.
And again, if anyone wants a copy of the PowerPoint that she put together for today, please reach out to me, Katie at financialinsights.com. Also, our YouTube library is available through our website at financialinsights.com, bottom right corner. Just click on the YouTube icon and it'll take you directly to all of the Wisdom with Women seminars that we have had thus far. We're celebrating our 3rd year. So Jeannie, thank you.
Oh, you're welcome. Thank you.
And lastly, our next one is going to be on estate planning, and it will be on May 18th. So you will get more information on that through social media and through Constant Contact.
Thank you.
You guys
Thank
rock.
you.
Have a great evening, everybody. Jeannie, thank you so much.
Thank you so
And
much.
thank you,
Jeannie.
Jeanne
Really
Sacks.
good.
She's amazing.
Yeah. Yeah, big shout out
You
to John.
You presented
Awesome.
complex information in an easy to understand method.
Very much so. Well said,
Yeah,
Dorothy.
there we go.
Well said. Thank
Yeah.
you, everybody,
Thank
for
you.
joining us
Bye,
today.
everybody.
Bye.
Bye.
Bye.